we go. Hello. Welcome to Little Legal Group Coffee Chat podcast. We're excited today to have Alex Seleznev with us. He is the founder of Capital One, Capital Squared. How come I don't have this on my sheet? I just have founder.
No problem. No problem.
So Alex is a financial planner who focuses on retirement planning. He primarily works with clients who are thinking about transitioning to or are already in retirement. Alex's unique approach focuses on minimizing taxes and creating fortresses of financial plans with different layers of protection. Ooh, I love that analogy.
I know.
So that way his clients can sleep well at night knowing their future is secure. Well, welcome, Alex.
Well, thank you, Megan. Thanks for inviting me, and great to be here with you today.
We're excited to have you. So tell us a little bit about your company that I completely screwed the name up on, and then we'll talk more about retirement planning.
No problem at all. Yeah, so the full name is Capital Squared Financial, or CSF. I mean, that's how I refer to us. I mean, we've been around for 1.5 years at this point. It's almost 4 of us. I mean, we're about to add a 4th person to our team. I don't really think of ourselves as a startup of sorts, and every so often people would refer to it this way because this is actually the 2nd firm that I founded. The first one was, acquired by a regional, I guess at this point, CPA firm, and then I thought I would do something different, and that's how I came up with Capital Squared. Again, we're a boutique style firm. We work exclusively with people, like you said, who are thinking about transitioning or in retirement, or their children. That's perfectly fine too.
So, all right, well, tell us when thinking about retirement planning, right? When should people start thinking about retirement planning?
That's I love those types of questions. So I'll give you 2 answers to that question. Of course, the sooner the better. There's no reason why someone in his or her 20s, 30s, or even 40s wouldn't at least think about it. Start saving for the future, trying to max out their 401k, 403b. That would be great. Now, in terms of what we do, I would say at least 7 to 10 years ahead of time. So let's say if you're thinking about retiring in your early 60s, as an example, I would say you really need to focus on it in your early 50s. Why? Because when we have 7 to 10 years, to essentially work with you, there are a lot of things that we can fix. And I'll say this, Megan, every so often, well, actually rather frequently, someone would reach out and say, Alex, I'm going to retire in January of next year. I want to make sure I'm on track. And I can certainly do an assessment. I can come up with a plan for this person. But as you can imagine, there's really not much we can change if someone is retiring in 3 to 6 months from now. So 7 to 10 years is my recommendation.
To really help build that fortress. Gosh, I love that.
I'm like, ooh.
All right. And so what are the most important things that people consider, right, when thinking about what that runway looks like and what they need to think about when they're thinking 7 to 10 years out?
Yeah. I mean, so goes without saying, and we can dive into that more, like talking about creating a fortress financial plan. You need to make sure that your finances are on track. I mean, so that's your number 1 priority. And that's, again, why people usually reach out to us. Now, what's important, and that's usually something that I would bring up, perhaps not in the first meeting, but like in the 2nd or even 3rd, one of the questions I would ask, well, why exactly are you thinking about retirement? Or sometimes I would say differently and say, well, what is it that you cannot do at this point that you're looking to do in retirement? And I'll tell you, Megan, in some cases, people just like, oh, wow, I already thought about that. I will be, playing more golf, hanging out with my grandchildren or my children. In some other cases, I get like a blank stare. Because people, they just never thought about that. They were focusing on, again, maximizing their 401k contributions, paying down or hopefully paying off their mortgages, which is extremely important. But when you actually ask them, what is it that you're going to do? In some cases, people don't know. So to me, that's important to have a life plan that goes beyond just thinking about your finances.
Yeah, we had someone we chatted with earlier today that called retirement rewirement. Ooh. Right? The period in which you kind of rewire what you're doing, what your plans are, that next stage, which I think is kind of a neat way to think about it, right? That you're ending maybe one chapter, but you're reworking your life into something new, and it's not just giving up everything and not working.
Well, that's such a fascinating topic, at least to someone like myself. Perhaps it's going to be surprising, perhaps not. So out of, let's say 10 people who reach out for the purposes of making sure that they actually ready for retirement, maybe 2 out of 10 actually retire. The remaining, 7 or 8 people, they actually do something else. I was working with someone earlier, actually two clients. They launched their own firms, small firms. They have a lot of contacts. They want to make sure they're still engaged. It's very important for people to be engaged, but it's actually relatively rare, even though, of course, it's entirely possible when people just retire and like almost do nothing, from day one and going forward.
I think I've heard you talk before about the 3 kind of phases of retirement, right? Was it the go, the no
go, slow go, and no go? Well, so this is, I would say, a relatively well-known concept, but it's probably worth reminding again to those who are thinking about it. So when you, develop a retirement plan for yourself, one of the common, not so much mistakes, but I would say misunderstandings, is to assume that people will be spending a certain amount each year all the way to, let's say, age 95. In the vast majority of cases, that's just not going to happen. Because first of all, you cannot really predict the future. And the second, perhaps the primary reason is what you just mentioned, is when people first retire, usually refer to those years as their go-go years. The first 10 to perhaps 15 years, depending on your health, of course, that's a big factor. That's when people want to travel more. That's when your, so-called discretionary expenses really go up. So I'll tell you in terms of, what we do on our end, we specifically account for that. Then you have your slow go years, usually 10 to 15, again, depending on your situation, when you spend some money on discretionary things, but you certainly don't travel around the world that much. I'll just put it that way. And then, of course, closer to your later years, these are your no-go years. Usually your discretionary expenses, well, in some cases that can be even higher, but these are mostly medical expenses and things of that nature.
Awesome. Tell us a little bit about the biggest difference between general retirement plans and specific.
Yeah, so this is another great question, and I love it. And I'll tell you, a good number of my clients, perhaps more than half as I'm thinking about it, they actually come to us with an existing financial plan that, frankly, in many cases was well prepared by some other professional. So I'm usually the one to look at it, perhaps critique it a little bit. Now, the biggest difference is really the level of detail. So a typical financial plan, to just say for someone in his or her 30s, perhaps even 40s, mostly focuses on how much you need to save, each year or each period, so that you can, accomplish a certain goal, have X dollars by the time you're 65 years old. And that's great. I believe everyone needs to have a plan like that, because you need to have, certain targets, how you reach those targets, pre and post tax accounts and all of that. Now, once you reach a certain point, one of the most important ideas, and that's where I see a lot of mistakes, is how you actually take the funds out of your portfolio. I refer to it as creating a distributions strategy. As you can imagine, I'll just use it as an example. Megan, you should expect to have, $10,000 in retirement to age 95. Well, that's great, but exactly how are you going to draw from your accounts? Exactly when will you be collecting your Social Security benefits? And specifically for those who are married, that makes a big difference. What happens when you turn age 73 and you're required to take, so-called required minimum distributions? Are you going to take advantage of the so-called, low income years or artificially low income years prior to that age to do, multi-year Roth conversions? And I don't want to get too technical here, but a retirement specific plan is much, much more detailed than a general financial plan.
So do you recommend folks work with someone that's more of a generalist in their 30s, 40s, and then transition to someone that looks specifically at retirement? Start with someone that can help them all the way through? What's your kind of thoughts or recommendations?
Yeah, so I'll actually perhaps only partially address your question. So first of all, you need to work with someone you're comfortable working with. I would start with that because, if you're looking for a retirement specialist and you meet him with that person, and perhaps they have great background, technical skills, but you're just not comfortable, chances are it's not going to work for you. But to address your question, again, it depends on the circumstances, and I try not to generalize too much, because even for some of my clients, by the way, I do have clients in their 40s, but their situation can be rather complex. So that even though, let's say, they're not thinking about retirement over the next 10 plus years, but let's say they have stock options, they have a complicated tax situation, and they need someone who can help them with that. Again, I'm trying to stay away from unnecessary details, but a lot of retirement planning work is around tax planning. Mm-hmm. That's what it really is. Usually it's one of those things that most people don't necessarily want to talk about, but that's, again, one of the biggest differences. So my answer to your question is work with someone comfortable working with.
Yeah, that's great. I think it's that type of question that we get all the time. It's it depends, right? It depends on your situation and your specific.
Well, you see, I will add to this, and I know this is, of course, a public podcast, so I'm trying to be gentle here, but make sure you understand, how your future advisor is compensated, as an example. So like the idea of being, fee-only advisory firm, which is certainly Capital Squared Financial. We get this question all the time, so it's easy to address in the beginning of the meeting. But I'll tell you, even in terms of our potential clients, still, even in year 2024, not everyone asks this question. So I'm usually the one to point that out. Well, we realize we don't sell anything. Our only source of revenue is what our clients pay us directly. That makes a big difference. Yeah. Very big difference in the type of advice that you're receiving, regardless if you're looking for a general or retirement specific financial plan.
Yeah, and you brought up a really good point. There are different types of financial advisors, there are different certifications, and there are different pay structures. Can you, I guess, just generally just kind of explain the difference between that? Because I know that a lot of people don't realize that.
Okay, so there are three standards, at least to my best understanding. Mm-hmm. There's a fee only, which is a golden standard. And again, at this stage in the game, and I'll just be blunt here, there's really not that many reasons for pretty much anyone not to work with a fee-only firm. And essentially what that means is, this person or this firm, they always serve as a fiduciary, meaning any type of advice they provide must be in your best interest. And sometimes, most importantly, they don't sell any products. Okay. So if I recommend, fund X or life insurance policy Y to any of my clients, there's no financial benefit to me if they actually, end up buying those products or not. So that's that. The second one is, it's interesting, they came up with this term, which is very similar, but it's very different. It's called fee-based. Oh. Fee-based. Okay. So what that entails is, I'm not going to mention any specific, financial institutions in this podcast, but you reach out to them, they'll design a plan for you. In some cases, they will not even charge you anything for the plan, which is like, wow, this is incredible. They're going to spend, multiple hours with me without charging me anything. But then you would realize, closer to the end of the process, that in terms of the implementation, every single product, like mutual fund, annuity, or anything else, comes from this one specific provider. So the advisor in this case receives what's called a trail commission on the products that you would be, investing in. Now, conceptually, I don't have a problem with that as long as it's fully disclosed.
Yes.
But, Yes, I'm not. I don't think this is going to be too much to say. In many cases, it's not sufficiently disclosed. So then, when people realize that 3, 5, 7 years down the road, they're rather surprised. The third one, and I'll go over very briefly because, in my opinion, it doesn't really exist. It's called a hybrid approach.
Okay.
That's, I mean, you can still see firms that do that, but basically they split their practice into two. I don't think it's real because you're either fee only or fee based. When they say hybrid, ask more questions.
Okay. That makes sense.
I hope it's not too much information.
No, I think
good.
that's perfect because I think it's an area that people get very confused by, right? That it's hard to pick and you want to do what's best and they sound very similar, right? So easy to get them mixed up and there's a huge difference there.
Yeah.
So what inspired you, Alex, to become a financial planner and work in this area?
Also, a variety of things in terms of becoming a financial planner. I'll just talk about the most recent, I guess, in terms of Capital Squared Financial. So again, in terms of retirement planning, I feel like it's a combination of three things. So of course, you need to have a very good understanding of general financial planning process. And to the earlier question, I'm also a certified financial planner, which is kind of like a golden standard when it comes to financial planning. You'll certainly need to have a good understanding of investments because yes, we do deal directly with investments. And in many cases, you're managing someone's entire lifetime savings. So it's important to have a good understanding of that. So I'm also a chartered financial analyst. The third piece, which I already touched on, is tax planning. So, prior to launching Capital Squared, actually, I used to be a partner at a regional CPA firm. I'm not a CPA myself, but I've done a lot of, tax planning work. So once you combine the three, and believe me, it took me some time to really process this. Well, what would be the best way to essentially apply your skills? What is it that you're passionate about? And for me, it was, again, helping people to successfully retire and certainly stay in retirement without running out of money. Now, the trigger point, and I mean, I've shared this in other podcasts and seminars, was really my father, who passed away at the age of 70, right around, well, not so much this time, but November 25th of 2020. Again, without going into too much detail, what really kind of sparked this, we're talking about a person who spent his whole life saving, wearing the same pants for 20 years, always thinking about the future. At the end, he didn't spend any of his lifetime savings. So in some sense, and I actually like to share this with my clients and specifically my future clients, one of the things that's unique, I actually encourage people to spend more. All of us want to plan to age 95 to age 100. Again, I'm not going to bore you with all those statistics, but it's, living in the now. So to me, that is so important to really enjoy your lifetime savings.
Yes.
Yeah, I think that's, I know there are clients that we've had that we have encouraged to please go spend.
Please go spend some money.
You're not quite at the point in which you need to do any tax planning, but you need to go and spend some money.
Well, what are you waiting for? You're 85. Go have some fun.
Please. So what is one piece of advice you wish that more people understood when it comes to planning for retirement?
Well, I'll start by saying that everyone needs to have a plan. That is a general and perhaps biased statement that comes from someone who's a financial planner. And specifically when you're thinking about retirement. Because again, what's at stake here? As I mentioned earlier, these are your lifetime savings. And for many people, this is more an optimistic outlook. We're talking about your next 30 years. So again, for someone who's thinking about retiring in their 60s, perhaps mid 60s. So when you're making decisions based on certain rules of thumb, it can get you in a lot of trouble. I mean, I have a lot of stories to share here if anyone is interested, but there are a lot of issues with not properly planning, just kind of thinking, okay, there's a calculator and that's the end of it. You have to be very careful.
It sounds like a lot of the conversations that we have.
You're not biased at all.
Not at all. They're similar conversations, right? That you need to do something and have a plan. Yeah. Or
Well,
bad.
Megan, to that point, and we talked about this in the past. I mean, in terms of our checklist, we have a variety of checklists, and this is the so-called onboarding checklist. Do you have an estate plan in place?
Right.
And usually that's one of the first questions I would ask as part of the onboarding process. And to my surprise, I mean, Megan, I'm sure you wouldn't be surprised. So many people with significant assets, they either have nothing or they have some kind of will that they drafted 20 years ago. It's scary. It's scary. And so then I would share, what can potentially happen. And in many cases, by the way, that's the priority. Get your estate planning documents in place.
Yeah. So, all right. So the last question that we have for you is, what's one item you couldn't live without in your day-to-day life?
One item I couldn't live without. Are you talking about on the personal or professional level?
Anything.
What's one thing you couldn't live without?
Well, it's probably going to be a boring answer, but I cannot live without my laptop. If you're talking about a professional life, because we're so connected at this point, on the personal level, that would probably be tennis. I'm a tennis player, and I try to play, almost every day as the time permits. So that's something that is such a huge, life improvement for me.
Good. I love that.
Yeah, this is such a fun question. We ask everyone this question.
I wish I could come up with a better answer as I'm thinking about it now.
No, not at all, but it's been a lot of fun to hear what all the different responses are. So,
but that does make me think, because again, most of what we do at this point, we certainly meet with our clients in person, but probably a good half of our clients, it's all on Zoom. So it's like, wow, how would you operate without computers? Yeah.
All right. Well, thank you, Alex. We really enjoyed having you join us today. So, and we'll share Alex's information if you want to get in touch with him in the notes. And thanks for joining us.
Thank you.
Thanks so much, Megan. Thank you.